Welcome to the Deep Dive. Today, we're focusing on a company that, well, it feels like the ultimate high-wire act in modern finance. Upstart Holdings, ticker UPST. This is the AI lender promising to redefine credit, but its stock price is famously, a roller coaster.
That's putting it mildly.
So our mission today is pretty straightforward. We're going to drill into the sources you've brought, earnings reports, financial data, even an independent fair lending report to tackle that core question for investors. Is Upstart actually a good investment, or is the risk just, well, structurally too high?
It's a really essential analysis because Upstart isn't just another fintech story. It sits right at that intersection, that collision point between disruptive AI and the frankly brutal realities of the credit market.
Yeah.
The documents we've looked at, they really distill this complex duality. You see a company hitting significant milestones, achieving things.
Right.
But those wins are kind of overshadowed by these unique vulnerabilities, things that make its survival acutely sensitive to factors outside its control.
Absolutely. And cutting through that volatility, that noise, means we really need to understand the core story here. So our goal for you listening is to walk away with a clearer perspective on, the massive growth potential that could be there with their tech versus these really significant, kind of unique structural risks the platform is facing right now. Let's dive in.
Okay, let's start with the absolute fundamentals of the business because I think this gets misunderstood quite a lot. Upstart is not a bank lending its own money, right?
That's the crucial distinction, yeah. It's fundamentally a platform. Think of it as a cloud-based AI lending platform, a tech matchmaker.
A matchmaker. Okay.
Exactly. They connect borrowers who need loans with banks and credit unions who want to lend. Upstart makes its money mostly from fees.
Like referral fees, servicing fees.
Precisely. For originating the loan on their platform, and this is key. It's a capital light model.
Meaning they don't need huge amounts of their own cash tied up. Exactly. They can scale up volume relatively quickly without holding massive amounts of credit risk on their own balance sheet. That's the theory anyway.
And the whole disruptive idea, their edge, hinges on their AI models being better than, say, the traditional FICO score. They analyze what? Over 1,500 variables?
That's the number, yeah. Over 1,500. Things like education, job history, variables FICO doesn't really touch.
But does it actually work? Is it really a better, faster, fairer model? Or is some of that just, marketing spin?
Well, it's the billion-dollar question, isn't it? But their recent financials, specifically Q2 2025, they offer a pretty big validation point, at least for efficiency and speed.
Okay, what happened in Q2?
It was what you'd call a breakout quarter. Revenue grew 102% year over year, hit about $257 million.
Wow. 102%. But the headline number, the one that really got attention, had to be GAAP profitability.
Monumental for them.
Yes.
Achieved GAAP profitability for the very first time. Net income was around $6 million.
And they did it sooner than expected.
A quarter sooner than planned, yeah. And for many institutional investors, the big funds, GAAP profitability is often like a minimum requirement. It signals a shift, potentially, from just a speculative growth stock to maybe a more mature fintech company.
Okay, beyond just net income, I want to touch on operational efficiency. Contribution profit that hit $141 million.
It did, which translates to a strong 58% contribution margin.
Right. For listeners maybe not deep in the weeds, what does that margin actually tell us? Why is that important?
Contribution margin is super important. It validates their unit economics. Essentially, it shows how much profit they make on each additional loan after you subtract the direct variable costs tied to that specific loan.
Okay.
So when that margin is going up, like it did here, it was 55% the quarter before, suggests the model gets more cost-effective as it scales, which is exactly what you want to see.
And the AI engine itself is driving that cost-effectiveness.
That's the idea. Their loan automation rate reached 92% in Q2. Think about that.
92%.
Almost fully automated processing. That ability to handle huge volumes without ballooning overhead costs, well, that's the AI thesis playing out in practice. It seems to be working on that front.
Okay, so the core model shows efficiency gains, but a major knock against Upstart, historically anyway, was its reliance on just personal loans. The sources make it pretty clear diversification is now central to their growth plan, moving way beyond that $2.6 billion in personal loans they did in Q2.
Absolutely. Diversification is the only real path to long-term stability for a model like this. The first big push is into auto lending.
Right, car loans.
Yeah. Originations there jumped 87% just from Q1 to Q2, hitting $114 million. And this isn't just random growth. It seems tied to their auto retail software getting traction with actual car dealerships.
So they're embedding the tech further up the chain where the purchase happened.
Exactly. Integrating it right at the point of sale, that's smart.
And the other big area is home equity, which saw, nearly a ninefold increase year over year? $68 million in Q2? That seems incredibly fast for home lending.
It is incredibly fast. Home financing is usually so slow and complex. The breakthrough there seems to be friction reduction.
How so?
They rolled out something called instant property verification. Basically, it lets borrowers verify ownership, income, the stuff that usually takes forever with the HELOC in under a minute.
Under a minute, that's quite something.
It really is. That kind of speed advantage in a traditionally slow, paper-intensive market, that could be a genuine competitive moat for them.
So if they're making these moves into huge markets like auto and home, how does that tie back to the capital light model we talked about? Are they holding these loans?
That's the crucial link back. Management's stated goal is to move most of these new auto and home loans off their own balance sheet by late 2025.
Using third-party funding, partnerships.
Exactly. Finding banks and institutions to buy that loan paper is the classic fintech expansion playbook, right? Think PayPal moving into merchant solutions or Intuit buying Credit Karma. Expand into adjacent markets, but keep the core business as a high-margin, fee-generating platform, not a risk-holding lender.
Okay, we've painted a picture of successful growth, efficiency. But this high-flying act rests on what feels like a pretty fragile foundation. If part 2 was about operational success, part 3 has to be about that fragility. Let's start with concentration risk.
This is the big internal fragility of that capital light model you mentioned.
Right.
Because Upstart doesn't want to hold much credit risk itself.
Right.
It means they are utterly dependent on their bank partners actually buying the loans originated on the platform. And the numbers are stark. In 2021, just 2 banks originated 91% of all the loans.
91% from 2 partners.
Yes. And those 2 partners accounted for 83% of Upstart's total revenue.
Wow. That sounds like an existential vulnerability. I mean, if just one of those major partners pulls back, decides to cut their loan quota by even, say, 50%.
The disruption would be massive, catastrophic potentially to both revenue and the customer experience.
Is there any sign they're fixing this?
Well, there's some mitigation. The biggest partner, Cross River Bank, its share did fall. It was 89% back in 2019, down to 55% in 2021. So it's improving, but 55% from one partner is still extremely high concentration.
Okay, so that's the internal threat. What about external risks?
The big one, the unavoidable one, is the macro environment, specifically the Federal Reserve and interest rates.
We've definitely seen that play out in the stock price. The sources noted the stock plummeted over 55% from its highs near $90 earlier in the year, down below $40. Clearly very sensitive to rate hikes.
Extremely sensitive. The market is terrified of what rising rates do to their model and loan demand.
But wait, if their AI model is supposed to be so predictive, so good at assessing risk, why didn't it handle this rate sensitivity better? Why did the stock get crushed so badly if the model is superior?
That's kind of the core question, isn't it? The challenge is Upstart's AI is mostly operated in what analysts call benign market conditions, since it really got going around 2014. Relatively low rates, steady economy.
So it hasn't really been stress tested.
Not in a sustained, truly challenging environment, like a deep recession or a prolonged period of very high interest rates. We just don't know for sure how the models hold up under extreme stress. And compounding that is their financial leverage.
Right, the debt.
Yeah, they have about $1.5 billion in debt against a market cap around $3.6 billion. That gives them a pretty high debt-to-equity ratio, around 39%. High leverage plus rate sensitivity is not a comfortable mix.
Okay, let's pivot to maybe the most critical and certainly the most nuanced risk detailed in the sources. The integrity of the AI model itself, specifically around fair lending. This feels like it cuts right to the core of their value proposition.
It absolutely does. There was an independent monitor mandated as part of regulatory oversight.
Okay.
And this monitor found, and I'm quoting here, statistically and practically significant approval disparities for Black applicants compared to non-Hispanic white applicants.
Yeah.
This was based on data from late 2021 and early 2022.
Wow. That finding alone seems like a huge problem. Doesn't that suggest the AI thesis, the better, fairer part, might be flawed? If it's truly unbiased tech, why this outcome?
It raises fundamental questions about the inputs, the variables they use. The monitor highlighted the use of non-traditional variables like higher education criteria.
Okay.
And these create what are called proxy risks. Basically, even if a variable like education is legal to use on its face, it might unintentionally correlate too closely with a protected characteristic like race or maybe age. So legal inputs could potentially mask an underlying discriminatory bias.
So this finding triggered a requirement for them to investigate, what were they called? LDAs?
Less discriminatory alternatives,
Yeah.
yes. Essentially, they had to see if there were other ways to build their models, other LDAs, that would still predict risk accurately but result in less discriminatory outcome.
And did they find did fixing the bias mean they had to sacrifice the model's accuracy? Because that would kill the business case with the banks.
Crucially, the report suggests no, not necessarily. They identified at least one potential LDA called Model 2 in the report.
Okay.
That looked viable. And here's the really key takeaway for you. Model 2 performed essentially identically to their main baseline model when it came to predicting default risk.
Identically.
Identically. The monitor suggested they could have improved fairness without significantly hurting the predictive accuracy their bank partners rely on. That's a major finding.
All right, so given this really complex picture, clear efficiency and growth on one side, but serious volatility and these structural risks, especially concentration and fair lending, on the other, how is Wall Street actually viewing Upstart right now?
Sentiment seems uh, cautious is probably the right word. While the stock did climb, was it 16.8% in the 6 months leading up to the source date?
Which sounds decent on its own.
It does, but that actually underperformed both the broader fintech industry and the S&P 500 during that same period. It suggests the market is maybe still waiting for more proof points, more evidence of sustained durability.
And investors are paying a pretty high price while they wait, right? The valuation metrics look steep.
They do. The market is definitely still pricing in a lot of future growth. The stock carries a price-to-sales ratio, PS, of 3.77x.
Which is higher than the industry average.
Slightly higher, yeah. The industry average was around 3.52x. It's not a massive premium, but combined with other factors, it gave the stock a value score of F in our source data, suggesting it's considered overvalued relative to peers right now.
And despite those impressive growth numbers we talked about earlier, the official analyst consensus rating is only a hold, not a buy.
That hold rating really reflects the deep division out there. The average price target was around $78.83, but look at the breakdown. 5 analysts say buy, 7 say hold, and 2 say sell.
A real split.
A real split. Investors clearly have to weigh that huge potential upside against the very real risks and that premium valuation.
And it seems like that caution extends right up to the executive suite. There was some notable insider selling mentioned.
That's always a flag worth noting, yeah. Both the CFO and the CEO sold pretty substantial chunks of their shares in recent months.
Substantial.
Well, the CEO's transaction resulted in about a 44% decrease in their personal holding of the stock.
Wow, nearly half.
Yeah. Now, institutional investors, hedge funds, they still own a big piece, about 63% of the company. But seeing that level of selling from top insiders, well, it certainly suggests internal caution might be running high too. Hashtag tag outro. So, to try and synthesize all this, Upstart has undeniably delivered some major proof-of-concept wins. That GAAP profitability was huge. The AI model is demonstrably efficient in processing loans. And they have a clear roadmap to diversify into massive auto and home markets. But you have the high valuation, the proven sensitivity to interest rates, the still high concentration risk with partners, and this ongoing crucial fair lending scrutiny. It means, realistically, an investor probably needs a pretty aggressive risk tolerance, a strong stomach, really, to hold this position right now.
It really is the ultimate investment paradox, isn't it? You've got this exciting story, AI transforming credit access, colliding head-on with these structural fragilities tied to bank partnerships, and, crucially, regulatory compliance.
Which brings us, I think, to our final question for you to think about. The core of Upstart's whole valuation, its entire existence really, depends on its banking partners trusting its AI model.
Right. Trusting it's accurate and compliant.
Exactly. So given those fair lending findings we discussed, findings that suggested obligation to find and potentially use less discriminatory alternative like that Model 2, which maintained accuracy, the real long-term clue isn't just if their AI is predictive. We have evidence it is. The deeper question is, can they demonstrate that these required LDAs are not only effective, but also durable enough over time? Can they turn what looks like a regulatory burden right now into potentially a key competitive advantage that actually deepens partner trust because they've proven they can manage fairness without sacrificing performance? That's the long game.